Hey there, champ. You know, when our members are transitioning from absolute newbie trader to more of like an intermediate trader, and they finally learned about the different tools that we use in the markets for identifying all the different significant levels, then at that stage, one of the biggest issues that I see, and in fact one of the most common questions I get asked, is how do I deal with having so many levels on my chart? So, in this video, I'm going to explain how we solve that issue in an elegant way when using the Duomo method. There are certain themes that I constantly reiterate when I'm teaching people to trade. One of these themes is that trading shouldn't be viewed in isolation. There are many concepts and approaches that we can pinch and steal and transfer from other disciplines that will positively influence our performance in the markets. And with the Duomo method, in fact, we've applied many scientific approaches to help us build what we see as an elegant model for trading. And one scientific principle in particular that we follow is similar to that of Occam's razor, which Einstein probably explained best with his statement, "Everything should be made as simple as possible, but not simpler." One of our core philosophies is that everything must be logical. We don't want to overcomplicate our charts with a bunch of objects and indicators that really don't contribute that much to the overall success of our system. It's just like what Leonardo da Vinci said, simplicity is the ultimate sophistication. However, as William Blake said, I promise this is the last quote, "The road of excess leads to the palace of wisdom." And this is what we see with new traders using our method. Before they reach that critical level of experience to achieve profitable trading, they have to go down the road of excess. Too many trades, too many contracts, too many levels on the chart. Now, I've been asked numerous times about the benefits of having many levels on our charts. Surely, if we're just looking for a double confirmation with a type 1 or a type 2 close, the more levels we have on our charts, the more opportunities we're going to have. I mean, in theory, this is correct. The more levels on your chart, the more opportunities you're going to see, because the more interactions you're going to get. However, in reality, having too many levels can really be a bit of a problem. You know, when it looks like your chart is starting to resemble a plate of pasta, things just aren't right. This can end up being really distracting and can lead to either not opening enough trades due to paralysis by analysis, or opening too many trades and basically over trading. Luckily, with the Duomo method, solutions are always easy to find. This is one of the factors that makes our approach so elegant, because the whole method is built upon one underlying theory, which means that everything is interconnected and interdependent. Therefore, any potential problems are likely to be addressed by another aspect of the overall model. You just have to find it. So with that in mind, when I was asked this question a few weeks ago on our online forum, I decided to break down a few of the principles that we follow when we map our levels on the chart, which will naturally, by following these, lead to only having the important levels being shown on the chart. Number 1, only including the levels that will contribute to our analysis. This principle applies broadly to all of the next points as well, but it also does have its relevance on its own. So for example, in this chart, there are some levels which will never come into play again, simply because of the angle of the line and how far the price currently is from it. So take this level for example. When it was first drawn, the price was nearby and it was respecting it. The level was attracting and it was repelling the price. But such is the nature of angles that as time progressed and the price didn't move in the same way as the trend line, it ended up being too far away from the price and moving further every candle along. It's sort of like George Clooney in that movie Gravity, slowly drifting off into space. So that level has no relevance for us anymore and it needs to die. Sorry buddy, it's just the truth. Number 2, remembering that significant levels attract and repel the price. If you didn't already know, in the Duomo method, we understand that significant levels don't only repel or reverse the price, but they also attract the price too, sort of like a magnet. So this has some important repercussions for our trading and which levels we include on the chart. So let's say, for example, that you have two levels next to each other and one is clearly stronger than the other. due to a combination of two factors. A, it has more kissing points, and B, the reversals from the level in general move further and are not just in consolidations. So in this case, we're only going to be trading the stronger one because we know that it's likely to attract the price anyway. So this means that if you get an entry on the weaker level and it's nearby the stronger level, you automatically have an extra level of risk, since you have a strong level that's already going to be there to attract the price to it. So with that in mind, if we know we're unlikely to be trading it, the weaker level, we don't actually need to have it on our chart. It might be that the price ends up interacting with that level, type 1 or type 2 close, and not ever reaching the stronger level. And that's fine. We just don't want to have that risk on our hands. Sometimes the weaker levels can still be important and they can help to add context to our chart. For example, like I just said, there will be situations where it will react to that level instead and it will reverse or do whatever. So it's sometimes a good idea to keep a separate chart that you include absolutely every level on, so you can always refer back to it occasionally when you need to confirm why a particular stray movement took place. Number 3. Once a level appears to no longer be respected, we don't want to trade it. Alright, this one's pretty obvious, but I need to explain it because with the Duomo method, we obviously have very specific criteria that tell us when a level is not being respected or when it is or when it doesn't matter. So, when a level is broken, in other words, when the price just moves straight through it, then that's fine. We don't mind that happening. That level can still be relevant. It may now just work from the other side. There's no directional bias. So until we have a type 1 or a type 2 close on the level, we have no judgments to make about it. However, if we do have a type 1 or type 2 close and it doesn't do what we expect, so basically it doesn't react to the type 1 or type 2 close, then that level is no longer being respected and is unlikely to be significant. In this case, we'll either remove the level or just make it a dotted line, which would be indicating for us that is unconfirmed. So you're not going to trade it. Now you may also observe, if you're really following the candles closely, that there's never any reactions to the level when the price reaches it. So this may mean that the previous kissing points that you've used to draw that level are just a coincidence rather than actually meaning that it was a significant level in that place. There are also those situations when a level's been on the chart for a really long time, but it never gets the interactions with a type 1 or type 2 close. The price moves towards it, but reverses just before or breaks straight through. And in those cases, we might start to lose faith in that level, since it's never attracting the price, and we know that that's something that significant levels do. And by the way, if you're not sure about our interactions, the type 1 and type 2 closes, then you should take some time to understand the foundations of our method, which you can learn for free by signing up for our Inner Circle mailing list and getting access to our 4-part video mini-series that's going to teach you all of the basics. You can find a link in the description box, and also you'll find a link to a video that explains type 1 and type 2 closes for you on this YouTube channel. So if you don't know, now you know. Number 4, different levels have different strengths and this should be displayed on the chart. Let's go back to that first chart I showed you. You can see here that all the levels are drawn exactly the same way. However, in our analysis, we will want lines to appear differently. Thicker lines should be given to stronger levels and thinner lines to weaker levels. Dotted lines can be given to unconfirmed ones and solid lines to confirmed ones. And you may also want to color your lines differently depending on different things such as time frames or which trading session they were originally drawn in and that kind of thing. So this means that at a snapshot, you can see which levels matter more than others. The levels that are weaker can just be used to understand more of the context, the smaller movements that are happening in the market, or to help you to be able to increase your position size, while the stronger levels will be the ones that you trade based on the correct setups and a double confirmation. Simple, right? And finally, number 5. Some types of levels have a shelf life and have no purpose beyond that point. I think this one speaks for itself really, but if you're mapping the waves of a micro trend and the trend is finished, then we'll usually get rid of that micro trend line. It was only a weak line to begin with, since it's a micro trend line, not a baseline trend line, so it's unlikely to have an impact again in the future. And if it does have an impact again in the future, we'll just pick it up again as the new trend develops. And this is also the same for swing high-lows, which have a shelf life relative to the time frame you're trading. On a 5-minute chart, this will be 1 to 2 sessions, but sometimes 3 to 4, and a session is a day. For a 15-minute chart, it will be longer, but always an amount of time that is the same sort of scale as that. So you just scale it up. This also obviously means that if a swing high low is too far from the price and it's unlikely to interact with it in the next few sessions, then you don't need it there anymore because it has a shelf life. So there you have it, 5 points to follow, which will lead you to only having the essential levels on your chart. Now, these points are really basic and some of them seem obvious, but sometimes we all need a reminder just so that we can all keep on track and keep our trading as efficient as possible. There are also some more advanced things that we can do to keep our charts as essential as possible, but a lot of that relies on experience of the markets, and by that point, you should already have a feel for what's important and what's necessary and what's not. It all comes down to practice, 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 and screen time. So, thank you very much for watching. If you have any questions or comments, I'll be happy to read and answer them below. If you liked this video, which you'll notice is in a new format, then hit that thumbs up button and don't forget to subscribe to the channel and switch on notifications so you don't miss any of the new videos coming out. And I'll be seeing you in the next one very, very soon. Take care.